Good morning. That was pretty good. Not great, but pretty good. So look, it's a real pleasure for me to have the opportunity to get back in front of you. For some of you, this will be your second time with me. I had the great pleasure of speaking to this group 2 years ago, and I guess a bit like Saturday Night Live. You know, if you do okay, they'll invite you back to be a host again. So if I don't screw this up today, maybe Richard will invite me back for a third try. So it's a great pleasure for me to have the opportunity to spend time with you. I like to always begin by putting everything in perspective. And so I'm going to put things in perspective for you from a business perspective and a personal perspective, so you understand all of the comments that I'm giving to you today are from my point of view. And now you're going to get a sense to say whether you will agree with that point of view or not, right? So let me start with this. So my point of view happens to come from a pretty big insurance company. So AIG, outside of the country of China, measured by capital, is the largest insurance company roaming the planet Earth. We have about 63,000 employees. We operate in 200 different countries. And every business day, for example, today, we'll pay something like $110 million worth of claims. So when I'm talking to you, I'm coming from a really big insurance company. Now, how many of you, just by show of hands, are Dallas Cowboy fans? Okay. So first thing I want you to know is I love you, but I am a Philadelphia Eagles fan. Are there any Philadelphia Eagles fans in the room? Thank you. I love all of you. That, by the way, is me. And that's how we roll on Sunday mornings when it comes to Philadelphia. So I just want you to understand, again, where it's all coming from. So I'm giving you the perspective of this is from AIG. This is a global insurance company that is in that space in the market. And it's also coming to you from a crazed, lunatic Philadelphia Eagles fan. So, and if anything, if I were you and I were a Cowboys fan, what you should say is, he's just jealous, right? And that's fine. You should think whatever you want to think. But we're going to be really good this year. So here we go. What I'm going to do with you is the first thing I'm going to do is just set the stage a little bit and share with you why I think this is an absolutely critical time in this industry. Why I think that the whole idea of entrepreneurialism, the whole idea of innovation is without a doubt the key to the future. And then I'm going to talk to you about some of the things we see happening around us that are really driving innovation for us. So let me begin with this. This is a simple graph. You all can get your hands on this thing. Nothing magical to it, but I love to show it because one of the things it shows is you see the yield curve. There's 1990, 2000, 2010. Here we are in 2012, the worst time in the credit crisis, and then here you are today, August of 2015. And so you don't have to be a genius. You can see interest rates over a long period of time have been coming down. Just to put this in perspective, if you ran your insurance company at a 100 combined ratio back in 1990 with that yield curve, you could have a return on equity that was well into the teens, right? You could get a 14, 15, 16% return on equity. Let's call it on average a 16% return on equity. And today, that yellow line, that August of 2015 line, the same 100% combined would get you a return on equity well below 10%, something closer to 7%. So anyone who thinks, I'm just going to underwrite to an underwriting profit, interest rates don't matter, super, keep thinking that, but you're not right. So, in the context of where this plays out, different lines of business are impacted differently by this particular issue. So I'm going to show you, this is an AIG deal. Again, I'm giving you a perspective of where it's coming from. Shortest tail line of business, really fundamentally, we're dealing with in the commercial space is property. It's got an average duration of about a year. And so while interest rates in 1990 were giving me something like 7%, and today they're giving me something like almost nothing for a matched 1-year duration interest rate. So the truth of the matter is I'm getting about 700 basis points less in invested income, in interest income, when I get to collect those premiums and hold on to them until the time I pay out. The truth of the matter is it's only for 1 year. I can live with it. It's not the end of the world. I just have to underwrite my property business to an underwriting profit. That story gets more complicated as you look at other lines of business. This is the same story with primary casualty on a claims-made basis. The average duration is 4 years. I'm earning 600 basis points year after year after year after year for 4 years from the time I collect the premium until the average time that I pay out the claim. If you move that on to workers' compensation, primary workers' compensation, you're talking about something more like 6 years. Year after year after year after year after year after year, I'm earning less investment income. Since we only make money through our underwriting results and through investment income, this is a big challenge for us. And the story gets more complicated when I move you to excess casualty on a concurrent basis, and then the granddaddy of them all for us is naked, standalone excess workers' compensation, where the tail on that risk, the average duration of that risk, is something like 15 years. So we have, broadly speaking, exited the excess workers' compensation line of business. We've done that years ago. And why? You return me back to the investment results that I had in 1990, and I'll revisit the topic with you. But today, when I'm going to earn 600 basis points less investment income year after 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 year, it's a losing proposition. We cannot underwrite that sufficiently to an underwriting profit to be able to be sure that we can have a sufficient win-win situation that's long-term sustainable between AIG and our clients. This is not just a U.S. phenomenon. That was U.S. yield curves. This is the global stage. So I've shown for you Japan, which is that bottom blue line, Germany, the UK, and Canada. And while every country is different, fundamentally what you're seeing here is this is something that's playing out on the international stage. So this is not just a macroeconomic event affecting the United States, it's affecting the entire world. For anybody who says, that's still all really interesting, I just focus on making sure that I underwrite to an underwriting profit. Again, I think that's very interesting, but I want to show you one more interesting observation for all of you who are still doubters. These combined ratios will get you approximately the same return on equity. A 100% combined ratio in the United States of America would get you about the same return as a 111 combined ratio in Argentina. Meaning, I can underwrite to an underwriting loss in Argentina and still have a 7% return on equity because it's a highly inflationary economy and interest rates are higher and your return on your investments are different than they are in the US. But if you take that over to Greece, which is a deflationary economy, who quite frankly would disconnect from the euro if they could to be able to adjust their own currency and their own kind of monetary policy, but they can't. And because of that, they're a deflationary economy. And did you know you need to underwrite your policy to an 80% combined with a 20% underwriting profit to get to the same fundamental result and fundamental return on equity as you're getting from the United States of America? And again, it's just a AIG perspective, but I'm just trying to tell you this is a macroeconomic global imperative that says if you don't change, you're not going to win this game. So, out of all of this, I think has emerged a new landscape. There's a dark cloud and a light cloud. I'm going to let you guess which one I think is the dark cloud and the light cloud. But fundamentally, there's a big spectrum of insurance solutions that are available to our clients. And quite frankly, everything in between. You can be on the right side, you can be on the left side, you can be anywhere in between. And quite frankly, I'll also tell you, I actually think it's all okay. Meaning, I actually think it's just all reality. There's always going to be solutions on the right side of this equation, solutions on the right side of the equation, and companies in between, big and little. And so what is the right side and what is the left side? On the left side, I think it's really a lot of the new capital that we see, alternative capital coming into the marketplace. Generally speaking, product-centric, meaning, generally speaking, not able to provide a holistic solution to a client, not multi-product solutions, but instead, good capital. So there's a lot of capital. By the way, something like $60 billion worth of capital in this alternative space. It has something like doubled over the course of the last 3 years. It's getting big, and it's probably here to stay. And so what is it? Lots of capital, pretty cost effective. There's very little infrastructure to this capital. Very little infrastructure to the capital makes it a cost-effective solution, generally speaking going to play at the excess layers as additional capacity. It's going to be reasonably narrow focused on a particular product, on a particular niche, not a multi-line solution, and almost always focused on simple, plain vanilla risk transfer. That's what you're seeing on one side of the spectrum. On the other side is where I would say we're trying to be, and I know many companies, including many companies here in this room, are trying to be, which is just trying to differentiate from that. And we believe that the differentiation in this space comes from the ability to use innovation and science, the entrepreneurial element of what I'm going to talk about with you today. It comes from being able to have the infrastructure to deal with the claims. It comes from having the underwriting expertise. It comes from having a global network. We operate in 200 countries around the world. That's not free. It's not cost. It's not very low cost. It's actually high cost, but it's a totally different value proposition is the message I'm trying to do. A lot of work around loss control and engineering. And by the way, back in the day, maybe about a dozen years ago, I would have told you that our primary advantage is we've got a lot of capital fueling a great risk appetite and it's highly rated capital. I'd say to you, we still have that today. I just put that somewhere way down at the bottom of the list and say it's interesting, but many other companies have that too. It's the things above that that really make the difference. So I think the big challenge here is that innovation in science, and that's what I'm going to talk to you about. This is your traditional iceberg. So if you haven't seen one lately, just a refresher. 90% of the iceberg sits below the surface. In my opinion, again, speaking to you from my Philadelphia Eagles crazy lunatic perspective, as an industry, we spend way too much of our time at the top of the iceberg. We're trying to get to the razor edge, narrow answer on what's the lowest premium, what's the right amount of premium, which is the piece that everyone can see above the waterline. I actually believe that innovation and entrepreneurialism continues to drive what's happening in this industry. The real focus of how we can drive value to our clients, and quite frankly, the focus of the industry needs to be on reducing the total cost of risk. And quite frankly, in the future, I think you'll see us continue to focus more and more on reducing the costs that are beneath the surface. How can we reduce the total cost of risk without it being just about the premium? That is really a big piece of where it is that we're trying to take this picture. From my perspective, if we don't innovate, we're going to go the way of the dinosaur and we will be extinct. I think that's happening faster and faster and faster, and I'll try to make a case for that as I share with you in my next few slides. This whole concept of disruptive innovations evolving at an unprecedented pace, I think, is reasonably straightforward. I mean, how many of you grew up and did not have day-to-day use of the internet, didn't have day-to-day use of your iPhone? Even the concept of a BlackBerry, that's almost old-fashioned technology, right? But this concept of really a disruptive technology is really moving the world around us. And I think it's one of the greatest times to be part of the insurance industry because we have no choice. We have to respond to it. And I'm going to talk to you about some of those disruptive technologies. This, generally speaking, is what a lot of studies would say about the way that they view kind of successful companies. And generally speaking, you've got the research and development that goes into being an early adopter of new technologies, new innovative ideas. Those tend to be your most successful companies because they have a head start on everybody. So they are early with the research and development. They have the market to themselves. They can succeed in value maximization until the marketplace gets kind of catches on to it, and we get mass market, and we get lots of companies adopting. And then that's what you see in the middle. And so you'll actually see the initial innovator start to reduce in their profitability. And quite frankly, the initial innovator, generally speaking, goes back to the drawing board and keeps doing this time after time after time after time. But over time, the early adopters separate themselves, and then the mass market comes in, and then the mature market comes in. But eventually, everything really finds its way back to kind of a commoditized sort of business and a commoditized sort of marketplace. And so, without a doubt, the successful companies are going to be the ones that are the early adopters and the innovators. This concept of specialization of the driver as a driver shouldn't be a big surprise to you. This is actually, generally speaking, kind of empirical evidence. And what this says to you is that the top performing companies, which are in the blue, on general have growth in long-term book value that well exceeds the average performer, that well exceeds the underperformers. And again, big pieces of that deal with this whole concept of specialization. If you're an early adopter for innovation, you've got entrepreneurialism and you've got innovation. You're going to, and you've got specialization, exactly as Richard just said in his comments. You're going to find that your growth in book value tends to well outpace that of the average company, which tends to well outpace that of the lower performing company. My goal, our goal, is to be up here. So, all right. This is just a sort of reminder of history, maybe a little bit of history and a little bit of where we're going. This back in 1900 would have been the most innovative companies in the United States. You can see it's really back when we were an industrializing economy. That may be the phrase that I would use, right? So in the States where this was an industrializing economy. And you can see that list changed a bit in 2000 as I think we moved from industrialized economy toward a wealth economy. That's the way I would refer to it. You can see the nature of who those companies were and who the real leaders were in the innovation process was dramatically different. As a matter of fact, a lot of those companies from 1900 no longer even in existence, and certainly no longer on the leaderboard. But where it's headed in the future, I'd say in 2050, you're going to see that the innovators, the leaders, the ones that are generally recognized, are going to be in these spaces: software, aerospace, genomics, bioinformatics, nanotechnology, etc. You can see in a totally different space. And here's what I think is the challenge for the insurance industry. As an industry, we're pretty darn good at dealing with companies that needed our help in 1900. We're okay. There's a handful of companies that can do a really good job with the global, complex financial needs of the companies in this space here. And most of us, I might say all of us, are unprepared to be able to properly respond to what's going to be the opportunity and what's going to be the need for us in 2050. So I think without a doubt, we've got to pick up the pace and accept innovation and entrepreneurialism as a path forward. So I'm just trying to make the case for this is where I think we have to do it. So what are we doing? What's AIG doing in response to this? Some of you have heard this before. We have an office known as, led by someone who's the Chief Science Officer. The Chief Science Officer is a gentleman by the name of Murli Boleswar. Murli reports directly to the CEO, Peter Hancock of AIG. He leads a group today of just under 200 people, and they spend all of their time in science. All of their time focused on elements of science, whether it is data analytics, or whether it is behavioral science, or whether it's studying of the natural environment, or whether it's studying different particular disciplines of what can be a future for success for the organization. That picture, by the way, is a picture of Chuck Bednarik. He's also known as Concrete Chuck. He played for the Philadelphia Eagles. See a theme there. Chuck played for the Philadelphia Eagles in 1960, and the last time we ever won a championship. But he was one of the best football players of his time. And I use this slide to illustrate a point, because this player might be familiar to some of you. His name is DeMarco Murray. He used to be with the Dallas Cowboys. All right. So listen, jealousy is a form of flattery, right? So take it all as a big compliment. But what do I want to say to you? Great athletes, both in different time periods, but they have different tools around them that will make them better. Concrete Chuck did not have the best head protection. Rest his soul, he did pass away this past year, but Chuck, unfortunately, I don't think was well protected from concussions. I think better protection, although not perfect protection, for DeMarco Murray. Look at the face mask. So Chuck was a handsome guy before football, but obviously you can see the protection is different. I think of it fundamentally as the same story. We use science, and it can't replace the human being that's inside of that uniform. But boy, can we surround our people with different tools, different capabilities, different things that will make them more and more successful than they've ever been before. And that's what we're trying to do when I think about science. We have a ton of data. I mentioned to you that we pay about over $100 million, about $110 million of property casualty claims per business day is what we'll pay here in 2015. It gives us a ton of data, but a ton of data which is unstructured data that has to be turned into information. And a lot of those people on that science team that I described earlier are busy turning that into stuff like this, turning it into information which we can then use to help drive for a better answer for our clients, for our broker partners, and ultimately, quite frankly, for AIG, so that we can be here for the next 96 years. So we're 96 years old today. We'd love to live to be at least another 96 years. And we think this is a big part of the path forward. This is where I want to kind of talk to you a little bit about what's happening around us. I'm not sure how familiar you are with the Internet of Things. Take kind of a quick peek at the slide, and I'll just sort of put a couple words around this for you, right? So when I think about the Internet of Things, for all of you who aren't experts in this, let me just sort of keep this simple for you. There's something like 10 to 20 billion objects that are connected today through the Internet. Put this in perspective for you. By 2020, we expect that to be something like 40 to 50 billion objects connected together by the Internet. Now, what year are we in? This is only 2015. We're going to go from inception to date, going from 10 to 20 billion objects connected, and we think we're pretty darn connected today, to by 2020, something like 40 to 50 billion objects connected through the Internet. There's two things that are really driving this Internet of Things. One is the use of and the proliferation of these mobile devices. Somewhere, I have mine. So this wonderful mobile device, which is an airplane mode, by the way, but this wonderful device has something like 9 sensors in it. Anything from a device that senses light, that senses motion, that senses the direction, that senses my location, senses all of these things. That the cost of all of those sensors over the course of the last handful of years has come down dramatically. The cost of all of the sensors in this Apple iPhone, probably something like $7. So $7 to get sensors that years ago would have been very, very, very costly. And that's one thing that's really contributing to the Internet of Things, because it's the sensors connected to the mobile devices. So let's put mobile devices in perspective. Today in Europe, there's about 800 million people. There's about 1.1 billion devices like this. Maybe not this brand, but 1.1 billion. More than one per person. So when you've got the ability to be connected, and you've got the sensors, you can collect the data that can become the big data that allows analysis and allows usage as it gets transferred and turned into information. It is really, really, really changing the landscape for us, and it's changing really quickly how insurance companies need to respond. I want to give you a little bit of a sense, kind of an insight into this, not from my words, but let me show you a quick video that I think will give you a sense.
The Internet of Things is much more broadly a story about the digitization of things and the digitization of information. The blending of this physical and digital world is happening now.
As you get to more and more of the systems being interconnected, who's responsible?
Are we measuring new risks that we couldn't price before, that we now can price? There's opportunity in there, there's also challenges in there. And this is the future that lays before us.
In a broader picture, it's about connected machines. It's about artificial intelligence. It's about new industrial ecosystems. Is it a revolution or an evolution?
We're moving into this period of experimentation where we're going to connect lots of things. There's no reason why we couldn't have, for example, temperature sensors built into our clothes that then connect to HVAC systems and allow the room temperature to adjust.
When we will have more self-driving cars, so when actually almost everything will be self-driving, you can find new interesting changes in the city. You can think about a city, for instance, where there's no traffic lights, and just cars simply merge and cross without bumping into each other.
And you could argue that the vehicle then becomes safe enough that I don't need seat belts, I don't need all of these other things. Like all of a sudden, the whole environment is in flux. The whole environment changes.
What if there was a device that could be implanted into anybody that had any history of high blood pressure, potential high risk for heart attack? That device would alert them and their doctor that that person was about to have a heart attack.
When you got this convergence of digital and physical, what happens also is that we produce an incredible amount of data. Big data requires new tools in order to analyze it.
When buying a car, you guys price car insurance based upon the color of the car because it indicates something about the user. What more might we know about the user if we had access to all of this different information? It will fundamentally change the way we think about risk, the way we price risk, and also the risks that we can price.
We need to learn together with our clients about how this phenomena is going to impact individual companies, individual industries.
Ultimately, it's all about keeping our customers safer.
So if you get a chance, that report is available to you. It's a very easy read. It's not heavy AIG. It just happens to be a report that we published, but it's heavy knowledge. And I would strongly encourage you, if you get the opportunity, take a look at that. It's a real cool way for you to get updated really quick about some of the things that are happening. And think about it. 10 to 20 billion objects connected to the internet today in 2015, most of the way through 2015, and that number is something like 40 to 50 billion by the end of 2020. So let me move past the Internet of Things, which I think is an imperative for change or disruptive technology that's changing around us. And let me talk about one of the things that they talked about on that slide. I had a real neat opportunity to do a panel with Richard Branson from Virgin Media earlier this year. Richard was over in the United States touting Formula E cars. Formula E racing. We actually did this session at a Formula E racing event in the streets of Miami. So it's Formula One racing, but the E means it's electric cars. So it was fueled by seaweed. Fundamentally, the fuel, we had to drink the seaweed on there. It was horrible. I would encourage you not to drink the seaweed fuel. But this alternative fuel being a piece of some of the changes that might be disruptive technology as we move forward in the next 50 years, next 20 years. Automated vehicles. Completely autonomous vehicles, you hear people talking about them coming as soon as 2018. We're only in 2015, or maybe as long as 2030. But the truth of the matter is, I suspect you're going to see some real progressive cities in the United States be the first ones to experiment with this kind of stuff. But a fully autonomous car, imagine calling Uber and ordering up your car, and it arrives but there's no driver inside of the car. Right. Just to put this in perspective, self-driving cars, and this is just some of the statistics that are out there, self-driving cars are viewed as possibly being able to reduce 90% of the U.S. auto accidents, preventing up to $190 billion of damages and health costs annually, and and saving thousands of lives. By the way, that's in the United States. The situation in terms of deaths and injuries per driver in the United States is dwarfed by that of what happens in Asia, which is multiple times that level, just to give you a perspective of how it can change the landscape and the global landscape. Google, many of you are familiar with Google Maps, and they've got their autonomous vehicles here. Did you know that Google's got 23 autonomous vehicles that have traveled over 1.7 million miles? They've actually had 14 minor injuries, and by the way, 11 times the Google car has been rear-ended by a human being. So on those 1.7 million miles, none of those 14 minor accidents were caused by the Google system. So it just gives you a perspective. This is happening. It's happening for real. I don't know how many miles you've driven, but driving 1.7 million miles and having 14 minor incidents, really not a bad track record. Delphi, back in March, launched a vehicle from the Golden Gate Bridge to New York City. They wanted it to arrive in Manhattan in time for the New York Auto Show. The vehicle was the first one to travel 3,400 miles across the country. It visited 15 states and the District of Columbia en route, and it made it successfully. 99% of the driving in that vehicle across those 3,400 miles was done unaided by computers. So it just gives you a perspective. I wanted to show you a quick video about that. It's a little relevant to our geography.
It's day 5. We arrived last night in Dallas. The engineers go through a logic and refresh how the computer systems are working. It's all going as expected. We'll refresh the team with new engineers from Silicon Valley. We'll stop in 3 hours in Kilgore and we do a quick checkup on the vehicle.
So we're in Kilgore, Texas.
So no, we don't. So it has sensors.
Well, you can say y'all came through Kilgore, Texas, just so I could see this car on my birthday.
So I think that's particularly neat. By the way, it's it's not even an automobile manufacturer. They manufacture what goes into the automobile, and they're out there testing technology that's going to really drive where we're headed with autonomous vehicles. In general, think about it this way. Go back to what I said. If you can reduce the number of accidents by 90%, because, by the way, most of accidents that happen are an accident caused by human error, by operator error, who are the operators, the human beings. And if you can take that out of there, you can have a much safer place. There's some great things that can happen, but does it mean that there will never be accidents? Does it never mean that there will never be a problem that requires insurance? The answer to that is absolutely not. It just means that the face of risk will change dramatically. I'm not sure if any of you had a chance to see this or this really caught your eye, but think about this. Your car arrives and there's no driver. How many of you start to say, I sure hope it's got proper cyber protection and that someone can't get control of that vehicle autonomously, or separately, and actually drive it off the roadway? There's no one there to protect it. Did you know that we had the first auto recall in the United States, actually I believe in the world, recently? Does anybody know who it was? It was Jeep, yeah. And so 2 researchers were able to successfully take control of a Jeep that was going down the road. This is very recent. It was only recalled within the last month. You imagine the complexity of what's going on as we start to head toward an environment where we might have autonomous vehicles which will be much safer. But does it mean that we won't have risk? No, we'll have risk. The risk will just take a different form than the risk took before. And insurers have to be able to solve for how do we get our head around that risk? How do we think about the changing landscape of risk? How should we respond to that risk? And how can we help make the world even safer from that? Those are the kinds of things that we're focused on day after day after day. Drones, kind of just yet another change in what's happening technologically. So today there's something like 40,000 drones flying in the skies. By 2025. They expect that number to increase fourfold to 160,000 drones out there. If you didn't know this, AIG was recognized in 2015, so this year, by Business Insurance with an Innovation Award because we put out a policy for unmanned aerial vehicles, which includes covering drones. So we'll cover the physical damage, bodily injury, or other liability that comes from involving a drone. That's put out by our Lexington organization, which is something we're quite proud of. But we're also in the spirit of being able to use this in claims handling. We were also one of the first insurers to get approved by the FAA to operate drones for risk assessment. We can actually use it for surety purposes. We can actually use it to inspect very tough to reach parts of the world. What you can expect from us. You go back to Hurricane Katrina. When the hurricane hit and we had all the damage here in the Gulf Coast region, one of the challenges that we faced was being able to access the places where we had to be able to access to be able to assess what the damage was. We have the ability today, a decade later, to be able to use drones to help do that. What we're working on, just to give you a sense, is we're working on before and after imagery. Our ability to image what it looked like before, to take a drone in afterwards, and to quickly assess, do we think there's damage, and if so, can we do something quickly to help adjust that claim in a manner that will be more friendly to the insured? Those kinds of things are really high on our mind. And I want to just close you out, just giving you a little bit of a sense of some of the things that we are seeing on the casualty side of the house. So we use drones, for example, a lot of times in the property space. But just let me comment for a moment about casualty. So much is developing really quickly. There's so many things we can do regarding worker safety. If you didn't know this, we insure over 1 million industrial businesses. We actually insure 99.6% of the Fortune 500. So that gives you an idea of sort of where we play. 10 million U.S. employees and 4 million commercial vehicles here inside of the United States. And the kinds of things we're focused on include stuff like, I'll go to the second bullet of the AIG Go Workers Comp, or Go WC. What that is we've actually created the ability for any injured worker to go in and monitor the status of their claim directly online. So you can actually just go online, demystify the entire claims process. So if you want to know whether your claim is advancing or whether you should be contacting the insurer because somewhere there's a problem, or you want to schedule an appointment with a doctor, or you want to schedule something, all of that is available online. And again, it's in the spirit of trying to use technology, trying to use innovation to demystify the process. And quite frankly, one of the biggest problems we learned that we have with workers' compensation is the three things that can typically fail you: communication, communication, and communication. Because when the worker feels as though they actually don't understand where things stand, you tend to get agita, you tend to get the nervousness that ends up creating a bad situation for the worker, but also, quite frankly, a bad situation for the employer and also for the insurer. And we're trying to eliminate that. This advanced injury analytics is pretty cool. We use over 100,000 different time-sensitive calculations that will route claims to the right claims adjuster based on severity, based on the complexity of the claim, and the nature of those calculations are actually refreshed every 30 days. So it's all time-sensitive information. And our objective is, let's get the right claim into the hands of the right person. Let's get to the answer as quickly as possible. And let's help get this worker back to work as quickly as possible. So there's a whole bunch of things that are going on. You can see a bunch of announcements coming out of AIG from an innovation perspective over the course of the next few months, including an announcement we'll do probably later this month regarding wearable devices and the use of sensors for in particular employees who are involved in construction. So I just wanted to give you that as a sense of where it's going. I hope I've made the case for it where economically this is what makes sense. It's the only path forward for this industry, and there's so much happening around us. We actually can't avoid it even if we tried. We can't avoid the need to innovate, the need to be entrepreneurs, and the need to continue to raise the bar. I love this as a great way to close. Thomas Edison talked about this, and it's a lot of the way we think about things. Not discount 10,000 ways that don't work. So we fail lots of times. We experiment with and are looking at solutions that may never come to market, may never be the right answer, but we're learning from those things all the time. And I would encourage all of you to do the same. So in the spirit of time, I'm going to stop there. If you have any questions, I will be happy to make sure also that you know this is my contact information. You should feel free to send an email message. For any of you who look at that picture and said it doesn't look like the same guy, something's wrong with his hair. I'm currently training for the Kona Ironman, which is on October 10th, and so I haven't cut this in a year. And it won't be. This is not that long, right? So this is what hair product will do to keep it stable. But sometime after October 10th, I promise to cut it again, and you'll recognize me if you see me on the streets. That's it. Thank you very much.